Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for October 31st of 2022. Please see our disclaimer for important information. On this Halloween day, let's revisit the GDP numbers from last week. You see here in a well-articulated chart of components of GDP provided to us by Charles Schwab. You can see that the third quarter of 22 real GDP is in that second column. First column represents the percent of GDP for the various components. You can see consumer spending accounts for almost 71% of GDP, and you see the consumer was okay, 1.4% in the positive. That was down from the second quarter. Kind of flat-ish from the first quarter, and you can see fourth quarter of last year fairly strong. So consumer spending was positive, not as positive it has been. The rate of growth seems to be decelerating a little bit. Oddly enough, government spending, which is only about 17%, it accounted for about a 2.4% impact to real GDP, and you can see that that's actually a fairly strong number relative to recent quarters. And a lot of that came from federal spending, but also from state and local as well. And then you look down at net export, which is typically detracts from GDP, but when you have a strong export number, which is what we did have, and we've had strong exports for a couple of quarters. And then that actually provides a positive influence. So net trade, again, kind of coupled with consumer spending and government spending to a much lesser degree, was actually very, somewhat additive to the quarter to get us to an overall 2.6% annualized GDP growth rate. You can see that compares against two consecutive negative quarters, which in themselves gave rise to speculation that we were in a recession earlier this year, which I don't think was the case. Gross domestic income was actually relatively high, labor market strong, and there was production data that was actually too strong, really, honestly, for us to have been in a recession. But you can see here 2.6. And I think the whisper number was maybe 3%, but the baseline estimate was somewhere between 2 and 3, and we kind of hit that square on. But as you look at this chart, and we kind of get into the other charts, I think one of the things that you're going to see is consumer spending is not going to be as strong as it has been. And again, it's 70% of the overall economic picture. It is pretty important. So I'd say, over the last couple of quarters that were negative, the first quarter had a lot to do with trade, and the second quarter had a lot to do with inventory. And, you see fixed investment down. Now that's going to continue to be down. And then net trade probably won't see the level of exports that we have because the dollar is too strong right now, and government spending is kind of a wonky number. It can go back and forth, but overall, I do think consumer spending is going to drive GDP lower in the coming quarters. Here's a quick look graphically at the components of essentially for the people that are a little bit more visual. You see on the left-hand side, that uptick to 2.6%, again, coming off two negative quarters. And you can see, the post-pandemic environment. Those numbers were fairly consistently strong there, but we had that reversal in the first quarter. And again, I think this is going to be the strongest quarter that we're going to see over the next 6 to maybe 9 months. And then you can see the change on the right from the various components. Again, kind of a graphical representation of the chart that we just looked at. You can see here net exports was actually a pretty strong influence, as was the personal spending numbers. Those two really combined for the number that we got, and that was essentially offset by the other components. Here is a look at the Wall Street Journal survey economists' probability of U.S. going into a recession over the next year. And this is actually taken as of the release of the GDP data. And so, even with the 2.6% GDP number, the probability is up there kind of around 65% 5%-ish, if you will. And you can see in prior recessions that that number has always trended higher. I kind of checked those boxes there in 2008 and then 2020 in the pandemic. And so we are trending higher in terms of that probability of recession. There seems to be a fairly decent amount of kind of groupthink, if you will, that assumes that that's going to be the case. Now, the other issue that we need to resolve is if we believe we're going into a recession, how strong a recession is that going to be? And I think that's still an open question. I think conventional wisdom at this point is that it's going to be somewhat shallow. With the increase in interest rates here on the short end now, kind of leading us to that slowdown sooner, that we can get better visibility about the pace of inflation sooner, so that these rate increases can kind of curtail, and we can kind of like ease into this recession and then into the next ensuing upmarket. Consumer confidence, you can see present situation. Expectations, oddly enough, had been really bleak for actually for some number of months, many months, in fact. You can see expectations in that blue line falling off, but they've kind of picked up lately as we've seen a change in overall confidence, even though the last leg of this survey series was down, but off its lows, I should say. Now, present situation, you see that one just kind of flagging. It's not necessarily going down, but it's really just kind of going sideways right now. And I would expect consumer confidence to go down before it goes back up. Here's the Case-Shiller 20-city composite home price index, and you can see what a change a year can make. And you can see this data series goes back to the beginning of this current century. And you can see that the month-over-month change was negative to about negative 1.32%, and that was as big a change as we've seen since the global financial crisis, frankly. So it's interesting now that we've had a pretty strong reversal in housing, and when you think about housing's influence on the total economy, it's not to be discounted. And so, when we think about elements in the economy that will help us slow down, that will help inflation slow, I think you can look at this as one area that is probably going to help us get there sooner. Bureau of Labor Statistics, Employment Cost Index, and you can see, employment costs, in addition to rents, are two things that I've mentioned for some time now that would be relatively sticky, but you want to see on a trend line basis, you definitely want to see those beginning to edge down. And you can see that here on the civilian workers quarter over quarter, and then also that's in the amber line. The blue line represents year over year. And you can see that that number is moving down, although it's off of a very high number. So we've got a long way to go in terms of employment costs to get back to where we were. I don't think that's going to happen overnight. It will take time, but directionally we can see that the environment is beginning to manifest itself into slower overall employment cost numbers. Here's the number for initial claims for unemployment benefits. Again, it's symptomatic of the labor market being relatively strong. I mean, that's symptomatic in that employment cost number that we just saw, too. We can see, what the Fed's looking at in terms of influence and how it manages rates. They would want to see this really begin to uptick. The claims for unemployment insurance really begin to uptick before they felt like, okay, we're getting to a more normalized labor environment. But that actually really hasn't happened yet. You can see a slight uptick here, but it's not terribly pronounced, and we're still at pretty low levels of unemployment initial claims. Here's pending home sales. We are at a fairly weak number right now. We're down 10% on a month-over-month basis in pending home sales. Pretty dramatic change. I mean, we're seeing price changes. Article in the Wall Street Journal this weekend talking about the Austin market in particular. And actually, there is a chart on that we've got in this pack this week. But very interesting how this market has really cooled off relatively quickly. Pending home sales, the index itself, you can see here, you've got to go back to the pandemic, and then you've got to go back again to the global financial crisis and its aftermath to find levels this low. Shipments of new manufactured homes. Interestingly enough, one of these things that you come across and you say, well, okay, that makes intuitive sense. People are trading down where housing affordability is tough, but prices are still relatively higher than they were, certainly than 2 years ago, even though they've come off their peak. But you can see here that manufactured home volumes are moving higher in response to that, just being evidence of people trading down to a lower cost product. Here's occupied rental units, and this is a very interesting thing. So, we talked about rents, talked about housing affordability driving people into the rental market, but oddly enough, we've had occupied rental units change from year over year. Perhaps a law of large numbers, because we have had, probably something over 400,000 in occupied rental units, at least an annual change for what, 4 years now. And one case it was two years ago it was almost 700,000 units. So we've had a lot of absorption, and so maybe it should be intuitive to us that rate of change should decline somewhat. Don't know that this is symptomatic of a slowdown in the rental, I'll call it the temporary residential area, but it is clearly evidence that the law of large numbers is kind of coming to an end. Here's gross private domestic investment in residential structures, and so this is kind of a proxy for kind of all things residential in terms of capital investment. You can see that that's been down for 5 straight quarters now, coming off of a fairly strong rebound post-pandemic. But again, we've seen bouts of sluggish residential investment before. Obviously, in the global financial crisis, you can actually see that before the GFC actually hit us, and you can see in prior recessions where that's turned negative for a number of months. And again, this is cyclical, something that you should expect to see, and something that is entirely normal to not overreact here. Here is the container shipping numbers. This has been probably one of the most dramatic charts that I've seen economic-wise here over the last several months. And when we talked about the cost of shipping, we talked about supply chain problems. We saw this number very, very high, and we have completely retraced that number back below its long-term average. Just phenomenal, actually. So costs of shipping have really gone down. Here's final sales to private domestic purchasers, and it backs out government spending to a large degree. And you can see that this number is slowing down. So again, there's some data that's still actually very positive in terms of suggesting economic growth, but there are certain data points that we see clearly where this economy is losing steam, and this is one of them. So final sales to private domestic purchasers, beginning to show some signs of erosion here. Here's U.S. durable goods orders. This is ex-transportation. You could see that durable goods orders now trending a little bit lower. It was actually well below expectations. So obviously we want to keep track of this, but clearly more evidence of things slowing down. The City Fed Manufacturing Index also trending in that negative area. Continuing the conversation on the residential real estate side, we've got a couple slides here from Redfin showing you, more evidence of this housing market slowdown. You can see here in the red, which represents 2022, Pending sales are down 35% year over year. You can see that now. Of course, there is a lot of seasonality to this, and you typically have a bump during the middle months of the year and a typical slowdown as you get towards the holidays. But you can see here clearly the deviation of current data relative to 21 and 2020. And we've also seen a decline in demand. You've got affordability issues with mortgage rates now approaching 7%. So you got a lot of buyers that are actually just kind of pulling back. They realize the mobility has changed now. Some of them have low interest rate mortgages now where they're currently living. They would like to move, but they don't want to trade a 2.5% to 3% mortgage for a 7% mortgage. And so they're just simply pulling out of the market for the time being. And you can see home buyer demand, this index is down 35% year over year. So clearly, I'd say a very clear manifestation of the current economic environment in the residential real estate sector. Here's that chart that I mentioned out of that article in the Wall Street Journal about luxury home sales in Austin. You can see this, this goes back to January of 2020, which interestingly enough was just before the pandemic hit. And you can see the rise in that number and kind of how it oscillates. But we're clearly on this downtick now. Data that's looks like it's from August, so it's a little bit dated, and I would expect that this number's even this chart is trending down even further now than it was back when this last data point was captured. Compensation for all civilian workers changed from previous year, and we talked about employment cost index before, and we see that it's like decelerating. This just reminds us that it's still pretty high, even though things might be cooling off in employment cost. But you got total compensation here that is clearly still moving in the aggregate higher on a year-over-year basis. So it's probably worth pointing out that the other data was kind of like month-over-month change in employment costs. So like the near-term visibility that we have is that yes, it's beginning to roll over, but when you look at it on a year-over-year basis, it's still really high. Job openings, clearly see this one trailing over. So, even though we haven't seen like a phenomenal number of layoffs or layoff announcements yet, we're definitely seeing the job openings and the JOLTS report. We're seeing this roll over a little bit, again, symptomatic of a slowing economy. Real disposable personal income here, you can see that, with the recession around the pandemic and the shutdown, personal income was it was positively impacted, positively impacted by stimulus payments. And you can see several rounds of stimulus payment here, but when you bear the weight of inflation on a slowing economy, even with wages that are moving higher, you can see the impact of inflation on this is pretty profound, and real income has actually gone down. Average rate on a 30-year fixed mortgage. I love this chart because it takes us back quite a few decades, in fact. And I've had a lot of interesting discussions with people that are a little bit older than I am lately that remember, this whole area, this whole time back in the early 80s. And I remember it too, but I was a lot younger and I was not a home buyer back then. But people that, that we have conversations with talk about those 16, 17, 18% mortgage rates. And you could see that for really a couple of years, as, just really on the eve as Paul Volcker was challenging inflation. Obviously these rates are driven by, on 30-year fixed mortgages, are driven by, and they kind of index to the 10-year U.S. Treasury, which at the time was exceedingly high because it was responding to hyperinflation that we were not enjoying coming out of the 1970s. And so Paul Volcker changed that, raised interest rates quite a bit. it put the economy into a pretty decent recession. And you can see that since then, there's been a secular downtrend in these mortgage rates over many, many decades until last year. And now we see this ticking back up. Now, there's been oscillations, as you can see here, very well defined, where things have gone down for a while and then gone back up and then gone back down. But this downtrend is clearly broken with the magnitude of the rate increases on 30-year fixed mortgages that we've seen this year. 3-month Treasury rate, this is the highest since 2007. So, we've had, again, all of these interest rates have moved up exceedingly high, to exceed, well, let me rephrase that. All of these rates have moved up by a considerable amount. In fact, if the year ended today, I believe the 10-year Treasury will have witnessed its worst one-year return ever. And this is because the magnitude of these rate increases, the magnitude of the inflation that we're fighting, and the sentiment level that gets baked into this, gets baked into the fixed income market. So just want to just point this out that that we are in a very unusual environment here. Massive inflows into bonds. This is really interesting. So, at a time where we're seeing all these massive interest rate increases and bond returns, the Barclays Aggregate Bond Index over the last year actually has a worse return than the S&P 500 does. And despite that, we see an amazing inflow into bonds from private clients, and this is from Bank of America, their global investment strategy piece. So I just happen to think it's very interesting here. We're having kind of perhaps non-intuitive trends in inflows into certain areas of the market that have been performing exceedingly poor lately. S&P 500 gap earnings, and we see this move lower, and we expected to see this. Now we do see slightly, positive trends out of certain parts of the market, but when you take the market as a whole, we are witnessing year-over-year negative growth in gap reported earnings. Now, we do see a lot of adjusted earnings that are better than this, but this just sticks kind of strictly to the generally accepted accounting principles definition of earnings growth year over year. But would expect this number to continue to remain fairly weak for the next several quarters before beginning to turn back up again. Here is S&P 500 index. Put this into perspective. We've had a really good period of time here in the markets, and I just want to put this into kind of context. Though, as much as we want to get excited about this, I think the enthusiasm should be tempered a little bit. Now, I don't mean to want to throw cold water on the party here, but you can see that, like, from the January 4th peak here, a chart from Charlie Bolello here, we're down 27.5% to the October 13th low. And of course, since October 13th, we've had 2 weeks of really decent performance in the market. We're up about 11 to 12%, but we've had bounces before. You can see these noted here. In February, we had about a 9% bounce, and we had some softness, and then we had another 12 to 13% bounce in March, April. And then over the early part of the summer, we had about a 10% bounce, and then July was a really good month, and we had about 18, 19% bounce. So these things are actually pretty common within a bear market trend, which is clearly what we're in right now. And it's reflective of kind of the weakening economic environments. It's certainly reflective of expectations, and it's reflective of this uncertainty of not really knowing where earnings growth is coming from. We saw in that last chart that earnings growth just lately has been negative and is likely to remain a little soft here for the near term, and that's what creates this volatility that we're seeing in the market. So, perhaps these little bounces are tradable. But, again, if you're in a downward secular market, I think that becomes problematic. Good news is here that when you look at peak to trough to October 13th, I mean, that encompasses, almost 80% of a typical drop in a bear market that is accompanied by recession. That being, total drop being closer to like 35%, if you will. So, we're obviously a lot closer, if you believe that, we're a lot closer to the bottom than we are to the top. Largest industry weighting, top 5 stocks. I thought this is pretty interesting too from Bianco. And, you can see that, over time we've had, particular sectors that have been very influential, shall we say, in the markets. And, we talked about this in the middle of 2020 when we were coming out of this pandemic shutdown and we had this market resurgence and we had awful breadth in the market. I mean, the market was going up and everyone was excited, but it was driven by like 5 stocks, these FANG stocks. And you can see the influence here, even though the influence has gone down a little bit, we're about, the top 5 stocks in the S&P 500 being these FANG stocks, and it counts about 16, 17% of the total. At one point, it was closer to 23%, but still very influential. So that's why when you look at the S&P 500, it has a much more technology influenced bias in its trading patterns than it did, even as recently as 5 years ago. This is interesting. I do follow this. This comes to us from Schwab, and Schwab does a really good job of kind of tracking this. These are news stories that talk about foreign exchange headwinds. We talked about the dollar being very strong, and it is, and we want to be cognizant of that. But when you look at companies and their reports and their management interviews with Wall Street and things like that, this is a measure of how many times that subject of foreign exchange headwinds. In other words, the dollar is very strong and it's creating a problem because exports are very high or higher in cost when you have a strong dollar, and it's tougher to sell into your end markets overseas. And we just see that number is really picking up, meaning that it's becoming more problematic for domestic sellers to gain traction overseas. Excess savings by income quartile. Look at top quartile excess savings, still pretty strong, actually, for basically the top half of the population. Top 2 quartiles remains pretty strong, but then you see down below, you see overall excess savings going down. That's natural in an environment like we are now, people spending out of their savings. You see that typically happening at the lower income cohorts. But here really you see, even though it appears stable, I mean, this savings drawdown is happening at all levels of the socioeconomic ladder. And this one was interesting because it's like, real inflation is defined by, all of these different components and whatnot. You see in the blue shaded lines, you get the consumer price index, core CPI, which is generally less than the CPI because you're stripping out food and energy. Then you've got median consumer prices, but then, you've got, from the Dallas Fed, you have the trimmed mean core personal consumption expenditures price index. Then you have hourly earnings, and then you have year ahead expected inflation. You can see that number still is actually very low. And so when you look at real rates, and we know that they're challenged because of high inflation, what's interesting is there seems to be a scattering of opinions on year ahead expectations. Well, that will do it for the chart pack this week. I hope you've enjoyed it. I hope you have a wonderful week, and we'll obviously be monitoring kind of residual earnings for companies out there in the third quarter reporting season, and monitoring economic data as we head into November. Hope you have a happy and safe Halloween. Take care. We'll talk to you again soon.